Maverick traders, welcome out to your market roundup for October 18th. Corey here with you. And as always, as has been the case in 2022, plenty of volatility and things to talk about this year. It's been a great trading environment, not so much a great investing environment, but certainly good for traders. So as we look at the daily performance, a bounce back day. We didn't hold the gains of the gap higher, but we held some of them. And so we came off the highs, but still up 1% across the board. Most of the markets are up after hours on some upbeat earnings results. You can see oil got hit, gold was basically flat to mildly lower, so the commodity complex did lag today. As we look at advancers versus decliners, about 7 out of 10 stocks going up, and we've seen some improvement in the 50-day moving average. Now about 1/4 of the stocks above, where I think last week we were in the 17-18% range. So you're seeing more stocks kind of stabilizing, turning a little bit more bullish, a little bit more of a two-sided market as opposed to just the aggressive bear market we had been in for a handful of weeks. On the daily news, the reason that oil sold off sharply is more releases from the Strategic Petroleum Reserve. This is a reserve that basically, when there's a lack of supply, they can basically release oil, bring it onto the market, and it produces basically more supply, which tends to drive down prices, right? It's a supply-demand equation. If there's not enough oil and demand is overwhelming it, prices go higher. If they release oil onto the market, that produces more supply, it presses prices lower. And make no mistake, the Biden administration is trying to push oil prices down. Inflation is expected to fall sharply lower by most institutions. That is the projection, and frankly, that's kind of the path that it's on. However, inflation is kind of tricky because a lot of the things that go into the CPI numbers are things like rent, and rent doesn't go down aggressively. If anything, you're still raising rent, so they're slow to move. Inflation is backing up on some very important areas, but some of those things will tend to be very sticky. So I don't know that we're going to see a huge increase in inflation, but I'm not sure that it's going to go down dramatically either. It's going to be kind of a slow path where it gradually works its way back to 6% and 5% and so on. It's not just going to happen really quickly and overnight. SPY, as you look at it, why is this a little bit better market? Can you see the bullishness? Well, for one thing, we're back above the 20-period moving average. This is the first time really in weeks since you really broke here. You've basically maintained below that 20-period moving average until today. So is the market healthier? Well, yes and no. I mean, we're still in a bear market, so you can't get too wild on the upside, but we are seeing signs of stabilization, certainly buying pressure coming in. Last week was a very huge bullish reversal where we engulfed, multiple days with just one big bullish candle. It was a perfect exhaustion. Think about the exclamation point here, where you'd been selling off and you were oversold on a short-term basis, on an intermediate basis. The trend was down, the trading range, we'd been selling off, selling off, selling off, and then the big gap lower basically flushed out anyone that was willing to sell. And that's how it works, is basically you ran out of sellers. Anyone that was willing to sell sold on that day, threw in the towel, said enough's enough, and you just basically didn't have anyone else willing to sell, and you had some willing buyers, and that's the reversal that's kind of been building here. So as we look at the NASDAQ, very similar, huge bullish engulfing down here and kind of progressing mildly higher. I think it's still going to be a tug of war. My best guess is that we're not going too sharply. It's still going to be volatile, so I mean, expect volatility. You're going up, you're going down, but I think it's a good bet that we fast forward a couple of weeks and you're still relatively unchanged from current prices. I think we're in somewhat of a consolidation. Of course, you're going to move day to day, but I just don't know that there's a clear path here and clear direction in the very short term. As we look at the heat map, everything pretty much in the green. There were a few standout underperformers. mRNA and biotech was kind of bright red. Intel and Micron, Netflix was actually down, and now it's up sharply after hours on earnings. So some of those that were down, I don't know that I would take too much. It's kind of an individual basis, but for the most part, there was pretty much green across the board. Energy and commodities definitely lagged today. And where they've been huge outperformers, it does make sense to me that they're kind of tired here. We're going into earnings. They're going to have some really stellar numbers, but they've outperformed by so much that, again, I think they could kind of consolidate here as well. On the weekly performance, you'd have to kind of say, well, we're a little more bullish, still bearish, but acting better, right, on a longer term basis. We've now just ticked above, and so this, as of today, starts to turn green. We're just above the 20 MA. So let's come over and look at a few different bullish and bearish candidates. On the bullish side, looking for things that have relative strength, some outperformance. On the bearish side, usually relative weakness, underperformance. Always looking for chart patterns, recognition, setups, things that we can identify. So let's take a look as I do my scanning, because I think that's kind of the market environment we might be in. I'm a little more optimistic on Berkshire. It doesn't look great, but think about it. It's been above its 20 for a few extra days as compared to the markets. Today it got above its 50 period MA. And again, I think it's going to be a little bit of a work in progress, but what I'm envisioning is on the next pullback, I'm thinking I'll want to be a buyer of that. I think we establish a higher low. I don't know if it's going to come at this gap area. I don't know if it'll sink in a little bit further, but I'm looking to buy the next pullback. We are now making a higher high than prior highs. We've established relative strength compared to the market and other stocks within the market and so on. So I don't have to chase it here and don't really want to, but on the next dip, I think we establish a higher low. So some of these are not necessarily buying today, but maybe we have the characteristics that we'll be looking to buy. Crocs is in more of a consolidation. You can kind of call it a basing pattern up here. You could even call it an ascending triangle of sorts, but either way, really good price performance. We've been consolidating for quite a few weeks, even a couple of months now, and looks like it wants to make another push to the upside. So again, with Crocs, I would think bullish expectation, higher prices, outperformance. And then ILF, which is a Latin fund ETF, so playing basically Latin America as a group, and just again, relative strength, relative outperformance, consolidating. This is better than the S&P US markets. This is better than EEM, the emerging markets as a whole, Russia, India, China, Brazil. It's better than those. It's better than international developed, Japan, the UK, Europe, and so forth. It just has, as a segment, as an area of the market, relative strength. And then you can see kind of a higher low being established here. I think we go up and out. It's not going to be a fast mover. A big move for this ETF would be going to 27 from 25.50. So it's a very low beta, kind of low volatility area. AMC, still bearish. We've been talking about this and GameStop and those for weeks, saying, to me, you sell the rallies. Look for short setups. Any bounce is a shortable consideration. You know, here we have a bounce. Here we have a breakdown. Here we have a bounce underneath these lows. I think we use all of these to continue to play these to the downside. This is, I think, somewhat like shooting fish in a barrel. Now, you are going to get hit at some point, but you can probably stack up. I mean, good trade, good trade, good trade. You know, you can stack up quite a few winners here playing it to the downside, and then at some point you'll have a little bigger rally than anticipated. Next, we have Home Depot, and Home Depot, I think in terms of the pattern, here we have an inverse cup and handle, one of my favorites. Usually when you get this type of dynamic where there's a big rally, then it plunges back, perfectly retests the old support, and then the next bounce is kind of a rounded one, and usually this area, the handle, will be about 30% of the size of the cup. We have that dynamic in place, and I think this is just kind of choppy before that next leg lower. So some relative weakness in the shares compared to some other things, still below its 50-period moving average, and more than anything else, just kind of a price pattern that we can recognize and potentially take advantage of. Now, again, downward trending price action. You can see the huge breakdown. What I would expect is a little bit of a low base is kind of forming here. And it could break this way, in which case I'd probably forget about it. If it turns and starts to break lower, you can really kind of target a move off of this little channel. And again, it's kind of a conservative downside target, but a move towards about 32 per share. Maybe even playing this as a bear call spread. The exception to that would be if it gaps or breaks higher immediately. Assuming we just kind of stall here and start to pivot down, I think you could play this for another push down there towards about 32 per share. Markets are still in a bear market, but I anticipate some choppy trading coming up. That would be my best guess. Fast forward a couple of weeks and the markets are still relatively unchanged from current levels. It'll be a volatile way that it gets there, right? You'll have a big shot up, a big shot down, but again, the S&P at these levels, I think will be right around the same area of, call it 3,700-ish in a couple of weeks. Tech earnings really start in earnest next week, and then Fed meetings coming up, and a big debate about what's going to happen there. Are they going to hike by 75 basis points? Do they taper that back and only hike by 50? But we have a little bit of a window here where there's not too much. We don't have a jobs number. We don't have a CPI number this week. There are earnings, but large cap tech doesn't come until next week. So I think you've got about a week here where, again, that chop should really be in place until we get into tech earnings and Fed meetings next week. So expect a choppy environment in my view. Earnings reports, you still have quite a few companies reporting. The FedExes of the world. Oh, is that Freeport McMoran? Sorry. Schlumberger, Tesla, Union Pacific, AT&T, Verizon, so on. We're right in earnings season, so there's going to be a lot of companies reporting. Large cap tech tends to move the markets more than anything else. That's Apple, Amazon, Google. They all come out next week. Hope you've enjoyed the market roundup. Have a great rest of your day, and we'll see you next time. Goodbye, everyone.